Hello, I'm Noel Lim on ASEAN Speaks by Maybank. Amid relentless sell-off in the markets, our analysts discuss the opportunities in fixed income, Indonesian and Philippines equities, and a Malaysian ESG stock portfolio to capture the upside. Suhaimi Ilias, Group Chief Economist, speaks to them.
Good morning. Monday, 3rd of October. Let's start with the usual roundup of last week. Global equity market ended lower last week with MSCI World Index down 2.5%, MSCI Asia ex-Japan fell almost 4%, and S&P 500 dropped almost 3%, mainly amid turmoil in UK financial markets, reflecting negative reactions to UK mini-budget stimulus announcement by Prime Minister Liz Truss government consisting of large tax cuts, energy subsidies, and sizable borrowing that forced Bank of England to purchase long-dated UK government bonds to stabilize the market. At the same time, major Western central banks are on hawkish mode. US Core Personal Consumption Expenditures, or PCE, price index, widely seen as Fed's preferred inflation measure, rose by a higher than expected 4.9% year-on-year in August from 4.7% year-on-year in July, signaling US Fed still has some way to go on rate hikes to tame inflation. Bank of England chief economist said UK government's fiscal policy and the adverse market reactions that included pressures on pound sterling will require significant monetary response at its next meeting in early November, suggesting potential ratcheting up of rate hike from previous 2 rounds of 50 basis point increases. ECB President Lagarde said the central bank will continue hiking interest rates in the next several meetings, while several governors of ECB member central banks contemplate another 75 basis point rate hikes this month. US Treasury 10-year yield last week briefly breached 4% for the first time since 2008. Currency worry remains as strengthening US dollar continued to weigh on market sentiment and forcing major Asian central banks, namely Bank of Japan and PBOC, to intervene. BOJ reportedly spent a record 3 trillion Japanese yen or $21 billion US dollar in FX market intervention last week. Chinese yuan fell more than 11% against the dollar this year, on track to record its biggest annual loss since 1994. Officials step up efforts to slow the currency slide. Last week, PBOC imposed a 20% reserve requirement ratio for FX derivative sales and warned market participants against betting on the yuan currency. China's foreign exchange regulator also vowed to crack down on fake FX transactions. The previous week, PBOC asked state-owned banks to prepare themselves to defend the yuan by selling dollars from their foreign exchange holdings. Flash composite PMIs for US, Eurozone, UK remain below 50 in September, signaling contractions in economic activities, and are just barely above 50 in Japan and Australia. I think another thing to highlight is Russia-Ukraine conflict escalated further as Russia President Vladimir Putin signed accession treaties formalizing Russia's annexation of 4 occupied regions in the Ukraine, while the vital Nord Stream pipeline supplying gas from Russia to Europe suffered leaks, allegedly due to sabotage. Data-wise, this week we will have inflation numbers for Japan, Indonesia, and Thailand, and string of PMIs data for US, Eurozone, UK, Japan, and China. On air with us today have been Juye and Brian to talk through Singapore, Thailand, and Vietnam's macro and monetary policy. Winson on 4th quarter fixed income outlook. Anand on the sustainability research report, and we have Jacqui and Jeff joining us to talk about Philippines and Indonesia's market. Let's start with Harbin. Singapore's August industrial production posted second straight month of sub 1% year-on-year growth. And with data for the first 2 months of the quarter out, what is your expectation on the advanced estimate of last quarter's GDP to be out next week?
Hey, hi, morning. Suhaimi. So that's right. Manufacturing growth decelerated again to 11-month low in August. It was just 0.5%. That's down from the 0.8% in July. So 2 months of below 1%. And the drag was really from the electronics side. It contracted 7.8%, and that's the second contraction, second consecutive amount of contraction. And a lot of components fell back quite a bit, including semiconductors, consumer electronics, computer peripherals, data storage. All that was all in contraction. Chemicals as well fell minus 11%. There were a few bright spots, but like transport engineering, but that's not enough essentially to offset, I think, the contraction. So we are now looking for a probable technical recession in Singapore, looking at flash third quarter GDP growth of 2.2% year on year, but actually it's a quarter on quarter contraction, 0.6%. So that would be 2 consecutive months of contraction for Singapore, which is a technical. This is the definition of technical recession. Electronics PMI has also fallen below 50 for Singapore. So we are expecting, the government, when they come out with the MES decision, that the MTI may revise down their growth forecast from the current 3 to 4%. Our current forecast is 2.8%.
Habin, is there a likelihood of technical recession?
Yes, we think a technical recession is probably going to materialize in the third quarter, defined as 2 consecutive quarters of Q&Q contraction.
So with that in mind, another key Singapore macro event this month is Monetary Authority's policy review. Are we going to see 5th round of policy tightening by MAS, or would MAS kind of held back given the specter of a bigger downturn in the economy?
So I guess the MES faces a dilemma. On one side, there's a risk of technical recession. On the other side, inflation pressures remains pretty intense. So I think MES will probably opt for a recentering of the SingMia to the prevailing level. So another tightening, but we don't think they will do a double move, meaning they will not steepen the slope at the same time as a recentering, given the risk of a technical recession. The MES hasn't set a date, but it's probably going to be the 14th of October.
And have been another facet of inflation in Singapore is property price inflation. Has there been any move by authorities to deal with this?
So the recent move, the government has tightened some of the rules again. The main one I would say is probably the adjustment in the interest rates used to calculate what we call the TDSR, the total debt servicing ratios, and the mortgage servicing ratios. That could raise roughly the required installment payments, the down payment, by roughly about 5 to 6% for many buyers. The other big move is actually not allowing some of the sellers of the private property to switch to HDB immediately. So now there's a longer cooling period. This could actually, I guess, take away some of the steam out of the HDB resale market. But ironically, I think it could increase the rent pressure on the private side, since the folks who sell will have to find a place in the interim before they are allowed to go back and buy on the HDB resale market. So there are some reactions, but I think the government's probably mindful of not overreacting and not changing at least some of the stamp duty rules and so on. We should expect the MES to continue to hike the guidance on the interest rates that's used for the TDSR when the Fed keeps on hiking. So now the move is from 3.5% to 4%, but if mortgage rates keep on climbing, then I won't be surprised if they keep on raising it to 4.5% or 5%. We're expecting the mortgage rates in Singapore to touch 4.5% by end of this year, and possibly 5% middle of next year, simply based on the Fed's latest hawkish dot plots.
Right. Thanks, Abin. Jue, on Thailand, Bank of Thailand raised interest rate for the second straight meeting by 25 bips to 1%, but this was below your expectation of a 50 basis point hike. What's BOT justification for its decision? And in your opinion, is BOT right in being the least hawkish ASEAN central banks to date?
Morning, Suhaimi. Morning, everyone. So the BOT in the unanimous vote rose its policy rate by 25 bips, and the committee was of the view that a gradual policy normalization is appropriate given the overall growth and inflation outlook. In terms of growth, Thailand is lagging behind the rest of ASEAN. And also its household debt at 88% of GDP in the second quarter is among the highest in the region. And Thailand's inflation has not been demand-driven like that in the US. In my opinion, a 25 bips hike may not be sufficient to support the baht, which is hovering at 16-year lows against the USD. And the weakness in the currency may be sustained with current account deficit staying wide at $3.5 billion in August due to the white goods trade deficit.
How do you see the overall outlook for Thai economy and Bank of Thailand's interest rate policy path going forward?
Yeah, we are maintaining our GDP growth forecast at 3.2% for this year. That's slightly lower than BOT's revised forecast of 3.3%. Continued recovery in the tourism sector should drive growth in the second half of the year. Thailand lifted the last of its pandemic era travel restrictions on 30th of September. It waived the proof of vaccination for entry and also ended the nationwide COVID-19 emergency decree. And tourist arrivals have climbed to around 5.3 million year to date as of the 21st of September. And it's on track to reach the government's target of 10 million for the entire year. We expect growth to pick up to 3.8% next year. That's similar to BOT's forecast as tourist arrivals continue to rise. On the policy rate, we expect the BOT to hike by another 25 bips in the final meeting for this year in November, and another 25 bips in the first quarter of next year. That would bring the terminal rate to 1.5% as the tourism recovery gains momentum and also helps to boost the current account balance. We expect BOT to pause after the first quarter of next year on account of a global growth slowdown.
Last Friday, Thailand's Constitutional Court ruled PM's Prayuth had not exceeded the maximum 8 years allowed in office, so clearing the way for him to return to office after a 5-week suspension. I guess there won't be much by way of material economic impact between now and the election on 7 May next year, but anything to share about the upcoming election? Are we looking at return of elected civilian government, or we going to see a continuation of military-backed government?
Yep, so Prayut will return to office today as the court ruled that his prime ministerial term started from April 2017. So this allows him to remain the leader until 2025 if he is selected to lead the ruling coalition again, and if that party returns to power. For now, election rules still favor the military-backed group to retain power in the next election. But having said that, it will have to find a strong candidate if it faces stiff competition against the Pheu party. Prayut's popularity has been falling since last year. And based on recent polls by the National Institute of Development Administration, the Pheu party topped the poll as the favorite party to win the election for around 34% of respondents, followed by No Party at 24%, and thirdly, the youth-oriented opposition Move Forward Party. As for PM candidate, there's still no clear favorite person. Most voters, around 24%, think there is no suitable candidate, up from 19% in the June poll. Thaksin's daughter, Paetongtarn Shinawatra, is leading the poll, but support for her also fell to 21.6% from the previous 25.3%. Whereas, as I mentioned, support for Prayut fell for the fourth straight quarter to just 10% from the previous 11.7%.
Right, thanks, Jay. Let's move to Vietnam. Brian, Vietnam's third quarter GDP unsurprisingly surged to 13.7% year-on-year, from 7.8% year-on-year in the second Q. Is the economy firing on all cylinders, or was growth last quarter mainly a function of a base effect reflecting sharp rebounds in some sectors and industries from the contractions in third quarter last year?
Yeah, morning, Suhaimi. Morning, everyone. Yeah, so I think it's a combination of both. So, base effect did indeed play a part in the unprecedented third quarter of 2022 growth, with GDP in the third quarter of 2021 shrinking by 6% year on year. If there had been no contraction in the third quarter of last year, we estimate that GDP growth would have been significantly lower at around 6.5%. Instead of 13.7% as was recorded. Base effects aside, the economy continued to recover steadily due to robust demand. The services sector led with a 19% growth owing to improving tourist arrivals during the July to August peak tourist season, as well as robust domestic consumption boosted by reopening and a recovering labor market. The manufacturing sector was underpinned by robust external demand led by exports to the US. Suhaimi?
How do you see the economy doing this quarter and next year?
Yeah, I think that slowing external demand will show up more discernibly in the growth figures going forward, as the very favorable base effects in the third quarter dissipate. Preliminary trade data suggests that merchandise export growth weakened in September, with electronics being the main drag amid slump in global demand for smartphones and other personal electronic products. For the fourth quarter of 2022, I'm expecting real GDP growth to decline to around 5.7%. In 2023, I'm expecting around 6% GDP growth as compared to 8% this year, owing to rising recessionary risks in key export markets, US and the EU, on aggressive monetary policy tightening, as well as supply disruptions from the Russia-Ukraine war. So, I mean.
Lastly, the State Bank of Vietnam raised interest rates by 100 basis points, I think on 22nd September. Is that enough to stabilize the currency amidst, hawkish Fed feeding US dollar strength?
Yeah, so the Vietnam dong has continued to depreciate further against the USD since the 100 basis points rate hike. As of 2nd October, it has lost a further 0.7%. Taking its year-to-date depreciation to 4.8%. Although that said, the Vietnam dong performance this year is still better than a lot of other Asian currencies. Ultimately, like the rest of the emerging market currencies, Vietnam dong is not immune to US dollar strength amid the hawkish Fed rate hike cycle, as well as tightening US dollar liquidity. But in addition to raising policy rates, the State Bank of Vietnam has other instruments to support the currency, namely selling US dollars from its foreign exchange reserves, which amount to around 100 billion US dollars, as well as open market operations to withdraw Vietnam dong liquidity and indirectly raise interbank interest rates. These instruments will continue to be utilized actively. But we believe that this 100 basis points rate hike won't be the last that we see from the SBV. Further interest rate hikes will be needed to mitigate the persistent depreciation pressures and the risk of exacerbating imported inflation that comes with it. We are expecting another 50 basis points of interest rate hikes next year, likely within the first half. So,
thanks, Ryan. Bringing in Winson, released a note on 4Q fixed income outlook. Winson, first and foremost, how has bond market globally performed so far this year, and what are the key drivers and dynamics?
Hi, good morning, Suhaimi. It's been a very challenging year for bonds, especially over the past 1 month, like most asset prices. And using the word challenging is probably an understatement to describe the performance this year, because year to date, if you look at the total return, US Treasuries is down by more than 12%. It's with the worst on record. And US investment grade corporates actually perform worse. It is down by 18%, because in addition to the rates sell-off, the credit spreads actually widen. So UK was actually the worst. UK government bond total return at one point was down by more than 30% year to date. And this is even before we include FX performance, because the pound sterling was down by almost 20%. And the key drivers are actually hawkish Fed, global synchronized tightening by central banks that led to significant repricing in a number of asset prices, or most asset prices, including equities, although less for high yield credits. If the Fed indeed hike rate to 4.6% as projected in its forward guidance, the total increase of 450 bips is going to be the most forceful tightening cycle since the 1980s, since the Paul Walker era when the US inflation was running at 10-15%. But if we look at the relative performance, EM Asia bonds actually outperform because of divergence where regional central banks like BNM, Bank Indonesia, they have not been as aggressive and they are not expected to be tightening as aggressive as the Fed. So just for comparison, bond total return in local currency, China is actually up 3.5% year to date because of the PBOC cut rate. India and Indonesia almost flat, and Malaysia is down by about 2% year to date, better than what we see in the DM rates market.
What's your view on the directions of US Treasury and MGS yields this quarter and next year? And how should investors position in these volatile market conditions?
In the near term, I think bond yield can be anywhere, having seen the kind of volatility over the past few weeks or the month. The market trade on momentum, it can overshoot. And the treasury market currently is very, very volatile, extremely volatile. If you look at the MOVE index, which measure US Treasury volatility, the current levels are actually comparable with crisis level, like COVID crisis and also during the dot-com bubble. So no question, the number one priority of the Fed now is to fight inflation because US inflation is too high, the job market is too tight. They don't have any other option. But I think there are risks that the Fed will end up over tightening and not only cause a recession in the US, but it could be much deeper than what the market currently anticipates. So I think in general, the market has priced in a lot of risk for rates and for duration, but not for credit. For example, if you look at the US high yield corporate spreads on average, they are still trading lower than the peak in June, in July, and that seems a bit too optimistic to me. And credit sentiment can actually deteriorate on a lag basis on fast, aggressive Fed tightening. So I think government bond yields in terms of the outlook, treasuries and MGS, I think the yield can actually fall over the next 3 to 6 months if the US financial conditions actually tighten. For Malaysia, I think real money institutional investors with holding power, this sell-off actually has opened up a second window of opportunity to buy long durations. And I do think that MGS long duration provides an ideal hedge in ringgit asset allocation against the risk of a US recession.
Thanks, Winson. Anand, on the MIBG Sustainable Research Note, dated 27th September, titled Malaysia ESG Portfolio Refresh, what are the highlights and key takeaways from the report?
Yeah, hi, good morning, guys. So, I guess the whole idea behind this report was to see whether there was a causal link or a correlation at least between high ESG scores and stock outperformance. This really builds on the work that Jigger did at the ASEAN level with his report in August 12th. And for the ASEAN report, the correlation was not so great. It was relatively weak. We looked at 86 filtered stocks that we cover, and the filters being low to medium ESG risk ratings, decent quality of management, and low level of controversies. Those 3 filters, 86 stocks in our coverage across ASEAN satisfy that. But while they outperformed the MSCI ASEAN index, they didn't really outperform our broader coverage or even Sustainalytics broader coverage. However, as this report shows, when we look at Malaysia in isolation, the 31 stocks that satisfy the filter that I just mentioned, they were much more tangible in terms of outperformance versus not just the benchmark, but also the broader coverage universe. To take it one more level, as per the title, we took this opportunity to refresh our ESG portfolio as well. And there are 15 stocks in our ESG portfolio. We back tested the performance of those 15 stocks, or the 15 stocks you see at the bottom of the screen here. And these stocks outperformed everyone, really, both the benchmark as well as the broader 31 stocks in Malaysia that passed the filter as well. So conclusion, Suhaimi, is 2 things. 1, ESG does matter, or it appears to matter in terms of correlation between solid ESG scores and stock outperformance. And two, and perhaps more importantly for bottom-up research, bottom-up analyst contributions to ESG picks also matters, because for the 15 stocks we picked, we didn't just use the filters, but we also used the quantitative ESG 2.0 tear sheet scores that we have just rolled out since 2 months ago for all our stocks. And that is a key input in picking these 15 stocks as well. So both ESG's top-down scores, as well as bottom-up analysts' quantitative and qualitative assessments matter in terms of performance.
So which are the stocks that you would recommend as a must-have in a Malaysia ESG portfolio?
Yeah, I think when you look at this 15 stock portfolio, you will notice a couple of things. It's very balanced, both in terms of risk scoring, and it's also very balanced in terms of core business diversity. So, if we could do it, we would go for the whole portfolio because it provides diversification as well as a solid overall score. But I think when you look at the individual scores, the ones that score very high on our own MIBG ESG score, which is the second last column, you see that the banks do score high there. Hong Leong Bank is something that scores very high. Sunway Group, Yinson is a great transition play. It's an oil and gas stock now, but it's investing heavily in green technologies and green assets. So, we expect that value creation to come through as it switches more and more into green investments. And something like, Burma's Auto and Gamuda as well, we think would be quite good picks for any ESG portfolio.
Thanks, Anand. Let's move to Indonesia and Philippines equity, but maybe we start with Jeff first. Jeff, Indonesia stock market is up, I think 5.6% year to date. I mean, this is in stark contrast to the year-to-date declines in other ASEAN markets. So do you think there's more upside to the market, given the steady growth momentum and outlook, but rising inflation that prompted Bank Indonesia to turn more hawkish on policy tightening of late? I mean, what is your outlook for Indonesia's equity?
Good morning, Suhaimi. My outlook on JCI is that we recommend our clients to take profits. We think that with the US Federal Reserve still remain hawkish, and also after the DI rate hike, we think going forward there will be earnings downgrades. And also right now, JCI index is currently trading at a forward Bloomberg consensus earnings at 16.1 times, which is around the 10 years mean. So it's no longer cheap. So actually, we recommend our clients to take profit. But for the 2023 outlook, that we are quite optimistic. We have a year-end target next year at 8,050. We think that by first half, US Federal Reserve might be less hawkish, and also Indonesian economy will be likely to decouple from US recessions, and JCI should be riding on the EV battery narrative. On top of that, we think that with the election, the pre-election spending will boost the economy, especially the second half. But tactically, we recommend our investors to remain cautious and only buy on weakness. We prefer to go long on consumer staples names like ICBP, Mayora, and Calbe, and also a telco operator, a Telkom. And we only recommend buy on weakness on the big banks, the BBRI, BNI, and Bank Mandiri.
Thanks, Jeff. Let's move on to Jacqui. Jacqui, Philippines is like the opposite extreme of Indonesia. Markets down 15% year to date on factors like high inflation, aggressive rate hike by the central bank, weak peso, that I guess dominate investor sentiment and market flows. But is Philippines market ripe enough for investors picking? Where do you see the low-hanging fruits in terms of sectors and stocks?
Hi, good morning, Suhaimi. So yes, definitely. The market weakness is actually spotlighting the opportune buying window for high growth mode stocks. Out of the 41 names under coverage, 22 stocks are trading at more than 30% discount to their 5-year mean valuations. And of this 22, 17 have 2022 to 2024 above average earnings CAGRs of 14 to 60%. And further, of this, 17, six belong to our country and sector top pick list. So These 6 screaming buy stocks are top mobility picks, SM and GT Capital, our preferred telco, property, and consumer picks, PLDT or TEL, Ayala Land and DNL, and our transport stock, ICT. So all of these names are consistent value creators with positive enterprise value adds and with strong economic moats arising from their market leaderships and or niche positions.
Right. Thanks, Jacqui. Sorry, I have to cut it at this point. We're already 8:30. Just one more thing to highlight. This Friday, Malaysia will table its 2023 budget. That's it for today. Thank you very much and have a good day ahead.
Get specific advice from your financial advisor or trading rep. Check out our Maybank Trade app and also follow us on Spotify and Apple Podcasts. Tune in next Monday for our analysis on Malaysia's budget 2023. I'm Noelle Lim on ASEAN Speaks by Maybank.